Welcome to the Mondial 8 minutes, 4 questions with 2 charts. A new initiative whereby Sean Kelleher, CEO of Mondial Dubai, will be asking the relevant questions to prominent fund managers, finding out what their views are on the current state of the markets and in an effort to keep you guys informed. Today we kick things off with Glyn Owen. Glyn is a 45-year veteran in the industry, spending most of his time in the City of London. Today he's the Director of Investments and a member of the strategic team at Momentum International, a company which he helped found back in 1998. So let's see what he has to say.
Will the Fed cut interest rates? And if they do, how low can they go and what does it mean?
Well, the Fed has already cut interest rates to the lowest on record. They cut dramatically in the first stage of this crisis by 1.5% in 2 goes, very, very rapidly in recognition of the slump in economic activity. And rates are now back at the lower bound at 0. Now, remember, after the financial crisis, early 2019, the Fed cut rates then also to 0 at the lower bound. They stayed there for 7 years, but they never went below 0. And the Fed is very resistant to cutting rates below 0 because it's not clear that that will necessarily help to stimulate the economy further or help the functioning of the financial system. And the reason is that when rates go below 0 into negative territory, you've literally got to pay to have your money on deposit at the Fed or at a bank. So it actually has quite a big negative impact on banks. And if you look at the experience of those countries around the world that have cut rates to negative territory, the Bank of Japan and the European Central Bank are the big examples, hasn't been a great experience. So the Fed's very reluctant. What I think it's going to do is manage its balance sheet. It's going to continue to increase the size of asset purchases, including corporate bonds. It's going to manage the yield curve. It's going to manage interest rates on bonds. So I think we're going to have a lot of asset purchases, including corporate bonds and high yield bonds, to help the functioning of the markets, to help the credit system. And that's indeed what we saw back in late March when the Fed stepped in with its huge $2 trillion injection. So my view is the Fed will not cut rates below 0. It's on the agenda. They haven't dismissed it, but I don't think they will. I think they're going to continue to manage these monetary affairs with a huge balance sheet and supporting asset purchases, supporting the functioning of the system.
With the central banks pumping all this money into the system, they're spending. What impact do you expect that to have on the economies?
What it's doing in the first instance is providing liquidity. It's supporting the functioning of the markets. It's helping the credit markets, which dried up very, very dramatically in March for a couple of weeks. It's sorted that out. It's prevented a financial crisis. Now, the concern is if you combine that with these huge fiscal packages that governments have pumped in, particularly across the developed world, something between 10 and 15% of GDP has gone in with fiscal spending to support the economies. The combination of those things in time could actually produce an inflationary spike because you've got a lot of liquidity around. You've got the state spending big, eating up spare capacity. But the fact is the virus, the pandemic, has actually caused a complete global shock to the economy. It's hit a brick wall. And in this lockdown period, economies have shrunk by 30-35%. That's deflationary. So as we sit here today, we are in a deflationary environment where prices in many cases are falling. Look at the oil prices, a classic example. And I think we're going to have that sort of environment for some time yet, because we're only slowly coming out of this lockdown phase. So I think we've got a disinflationary environment. Uncertainty prevails. Businesses and consumers are not going to be all that keen to spend after having seen this dramatic size of shock. It's only longer term. You look several years out, you start to say, well, wait a minute, if governments keep their foot on the pedal with fiscal spending, which I think they will, central banks continue to ease policy, which I think they will, with more asset purchases, that does potentially stoke up some inflation. So it's not today's problem, but somewhere down the track, it could become a problem. And that's why in portfolios, you've got to keep some balance.
Lee, you mentioned the 30% drop in economic production around the world. So a lot of that is corporate suffering massive stress. Is there a risk? And of course, we're hearing Japan went into recession the other day. Recessions all over the place. Is there a possible global financial crisis?
No. The world is definitely in a very, very steep recession, the likes of which we haven't seen since the Great Depression nearly 100 years ago. It's much worse than anything since then, but it's a short-term shock. And yes, it could have produced a global financial crisis. That was what was beginning to happen in March for those couple of weeks where everything fell. Markets created, liquidity dried up, dollar funding dried up, but the Fed stepped in. And then other central banks followed with huge injections of liquidity. The other thing is that banks are in a much better shape today than they were going into the financial crisis a decade or so back. Bank balance sheets are much stronger. So no, we've averted that risk of a global financial crisis. And I don't think we are going to see that in this cycle, but we are going to see a very tough economic environment, which will gradually pull through. It'll be slow, but we'll get there. So no, financial crisis, I think that's off the agenda.
What about investors, right? So everyone runs for cover when markets are all over the place, but cash and bonds are not producing anything. So what's your recommendation? What are you telling your sons to put their money in?
What I'm saying is that you've got to have some diversification at all times. Diversification is the only free lunch in portfolios. So we are in a situation of very high uncertainty. So you keep some spread of assets, including a bit of cash. You want some precautionary savings in cash to ensure that you've got that certainty. I know it yields nothing, and it's going to yield nothing for years ahead. Interest rates aren't going to go up anytime in the foreseeable future. But to get your real returns, your returns above inflation, you've got to go beyond cash and government bonds, which are also yielding close to zero. And you've got to buy credit. So corporate bonds, which were badly dislocated in March, are cheap. They look really quite interesting. We've been buying those in our diversified portfolios. And then you've got to buy equities, because as we come through this lockdown, as the economies begin to recover, which they will do, we're in that process already as the lockdowns end, then equities will begin to benefit from that. And what we're looking at, high quality companies, strong balance sheets, good cash flow will get through this crisis, and their business models, in many cases, will actually benefit from the changes that have come as a result of this crisis. So diversification, keep a spread. The other thing I would also do is for that precautionary part of your portfolio, have a bit of gold. It's been the great safe haven over generations, and some US inflation protected bonds, which will protect you in the event that inflation sometime down the track does start to pick up. So diversification, your real growth is going to come from equities and credit.
How much in the gold? One quick question. Warren Buffett doesn't like gold, does he? He thinks it's a joke.
Yeah, but it's worked for a couple of thousand years. People have used it as a store of value, and I sort of rely on that. And it's worked pretty well in this crisis. It's the best performing asset so far this year. We've got about 5 or 6% across our portfolios in gold, and we're going to keep it. It may do nothing, but it will provide us with that ultimate protection. We saw it again this year when the world goes to hell in a handcart. What does well? US treasuries and gold. Fabulous assets to keep.
The first one I picked on our chart of the week, which is it's gone down really well with clients because it's a high opening rate. This particular week's one, you're talking about inflation, short-term deflation, medium-term inflation. Why is that important? Because we at Mondial spend much of our time planning people's retirement income. And if that's going to be attacked by inflation, they will want to know this answer. So what's your view on the future of inflation?
Well, that's a very good question, because as you say, it's key for clients to understand that. Look, at the moment, we are in a deflationary environment. Prices are under pressure. The oil price was a classic. You've got an oversupply of commodities, products, goods. And guess what happens? You know, particularly with oil, where there's limitations on how much you can store, price collapsed. It's getting a little bit better now, but essentially, this huge shock we've had to the global economy, where demand just dried up overnight. And if you're locked down, you don't go and spend. 35% drop in GDP overnight. Guess what happened? Prices come under pressure. So for the time being, we've got a deflationary environment. As we come out of the lockdowns, things will begin to get a little bit better, but I think it's going to be quite a cautious exit from the lockdowns, and people and businesses will be cautious. So I think for a year or two, inflation is going to stay very, very subdued, very low levels. But as we come through this, we begin to get back to the sorts of growth levels that were prevailing before the crisis. You know, when we've got a vaccine, let's say, in 18 months' time, when we've sorted out testing, tracking, tracing, all those sorts of things, got on top of the pandemic, growth gets back to normal, then you've still got these big fiscal and monetary stimuluses. I think they're going to stay with us. They could trigger a bit of inflation longer term. But the longer term numbers are still showing inflation expectations are below that 2% level, which is the historic level we've seen in the US. So I think what you've got to do is work on a deflationary environment now, but actually build some protection in your portfolio for the event that inflation starts to pick up again as we come out of this crisis, which we will.
The big question, which alphabet letter do we go to? We know that the markets suffered badly in March. Shares such as Apple was going to be a basic V, but we've got economies going into a recession. So as a recession, we've got IMF talking about depression. Which shape recovery are you looking at?
I think what is going to happen is that we've had a very, very steep drop. I mean, it really, in this lockdown period, when you've got people locked up, literally, you've got 35% drop in GDP. And across the developed world, certainly here in the UK and Europe, for the whole year, we could see a double-digit decline in GDP. But it's a short-term shock. You know, we are now beginning to come out of that, and we are going to start to go up the other side of the V. But I don't for a minute think it'll be a V that gets back up to where it was. That's far too optimistic, because there's been a huge shock. People are very cautious. Unemployment levels are definitely going to go up. There's big changes arising as a result of this crisis, and lots of things are going to be different going forwards. And you can point out as easily as me the sort of areas of the economies that aren't going to recover for years. The airlines are already planning for much smaller businesses going forward. So there's going to be bigger unemployment levels. So I think it's going to be an initial spike up as pent-up demand is released as we come out of these lockdowns, and we're seeing some evidence of that. China is a good example. And then it'll flatten off. It won't get back to the sort of levels that were prevailing before the crisis. It'll flatten off. So people refer to it as the sort of Nike shape or whatever, but I think it'll be a sharp dip down, sort of recovering part way, and then slowish but steady growth, taking some years to get back to where we were.